The materiality concept in accounting. Within the intricate framework of accounting, precision and relevance are paramount. The materiality concept, an essential principle, guides the determination of what information should be included in financial statements. The concept stipulates that accounting information is considered material if its omission or misstatement could influence the decisions of financial statement users. In this session, we will explore the implications of materiality concept, its practical application, and how it aligns with common sense. Introduction to materiality concept. The materiality concept, a linchpin of financial accounting, centers on the idea that accounting information should focus on significant items. It stipulates that items should only be included in financial statements if their exclusion or misstatement could impact the decision of users. The significance of size. At the heart of the materiality concept is the notion that materiality is often a matter of size. In other words, it depends on the magnitude of the item omitted or the size of the error. This concept does not imply that accountants are permitted to intentionally disregard small items or practice carelessness when recording minor transactions. Instead, it underscores that excessive, intricate accounting treatments for trivial items should be avoided. Let's explore the practical application of this. Consider the purchase of a stapler for the office as an example. While in theory, the stapler might be expected to be used for several years under the materiality concept, the accountant will record it as an expense in the period it was bought. Recording it as an uncurrent asset would necessitate time-consuming accounting adjustments, such as calculating depreciation. However, these added complexities would contribute little or no value to the overall financial statements. Another practical application of materiality concept in preparing financial statements can be found in the treatment of rounding adjustments. When dealing with financial figures that include decimal places, it's common to round off those figures to a certain level of precision. The materiality concept comes into play here to determine the degree of rounding required. For instance, imagine you own a business and your financial statement shows that you earned $354.62 in sales. Now, when you're preparing your financial report, you realize that it's a bit silly to include the cents, those small fractions of a dollar, in your report. Nobody's going to make a big financial decision based on those few cents, really. So in line with the materiality concept, you decide to round those figures to a whole number. So instead of writing 354.62 cents, you instead write 355. This rounded number is easier to work with and makes your financial statements more user-friendly without sacrificing accuracy or meaningfulness. In this case, the materiality concept guides you to make a practical choice regarding the level of detail to include in your financial reporting, ensuring that the financial statements focus on essential information. Another practical application of materiality concept is in preparing financial statements can be seen in the treatment of small, insignificant transactions. Let's say you run a small online business selling handmade crafts. Over the course of a year, you make many small purchases like glue, paint, and other supplies. Some of these transactions might be just a few dollars. According to the materiality concept, you don't need to record each of these tiny purchases individually in your financial statements. Instead, you can group these small expenses together under a category like office supplies or materials. This way, you simplify your financial statements and make them more manageable. The materiality concept allows you to focus on significant expenses and income that truly impact your business financial health. In this case, materiality concept helps you to avoid spending excessive time and effort meticulously recording and categorizing every minor transaction, ensuring that your financial statements remain focused on the most meaningful financial information. By applying the materiality concept in this way, financial statements remain practical and user-friendly, providing a clear and relevant picture of the business's financial performance without unnecessary distractions or complexities. Certainty versus usefulness. The materiality concept introduces a pragmatic perspective. It acknowledges that achieving 100% accuracy for every single small item in a business's records is often impractical, especially for enterprises with numerous transactions. Therefore, the concept reflects common sense. It recognizes that financial statements remain valuable to users as long as they present a reasonably fair and accurate depiction of the business's financial performance and position. Minor errors or omissions are unlikely to adversely affect the usefulness of financial statements. In conclusion, the materiality concept in accounting underscores the importance of focusing on significant information in financial reporting. It emphasizes that materiality is largely a matter of size, and the inclusion or exclusion of items should be guided by their impact on the decisions of financial statement users. The concept encourages practicality and aligns with common sense by acknowledging that the pursuit of absolute certainty for every transaction is often unrealistic. As long as financial statements offer a reasonably accurate view of a business's financial performance and position, they continue to serve their purpose effectively. The materiality concept reminds us to respect the significance in accounting information. My name is Arnold Kisembo Rangakuramia, and thank you for watching.